turning constructive on China and Hong Kong equities due to increasingly favorable fundamentals and corporate earnings trends. Where do we see investment opportunities today? Following several hotter-than-expected prints, April's US inflation data came in line with expectations and brought some relief. However, given that the Fed will need to see several months of disinflation before rate cuts, we see the Fed only making 2 cuts this year, starting in third quarter of 2024. For China and Hong Kong equities, we believe that the long-term risk-reward has turned positive. Earnings revisions have likely bottomed out, and a comprehensive policy playbook to turn around the ailing property sector is now in place, alongside various stimulus measures to boost economic growth and consumption. Moreover, we now have increasing visibility that a Lehman-like crisis is unlikely, and consensus growth expectations have started to rebound. Although US-China tensions are likely to persist, we believe that depressed valuations more than reflect a higher resting heart rate of geopolitical risks. Finally, the fundamental valuations of China and Hong Kong equities are compelling and remain one of the most undervalued markets globally. In our asset allocation strategy, we are upgrading our position in Asia ex-Japan equities to overweight, primarily due to our upgrade of China and Hong Kong equities to overweight. Within China equities, we favor undervalued names that provide exposure to the AI theme, large market leaders, and quality yield names. We continue to hold an overall overweight stance in equities and maintain our overweight position in Japan and neutral positions in US and Europe. In fixed income, we are downgrading our position in US Treasuries to neutral from overweight. With declining hard landing risks, a shallower rate cut path, and a difficult last mile of inflation, the potential appreciation of long-dated US Treasuries has become more limited. We continue to overweight positions in developed markets investment-grade bonds and emerging markets high-yield bonds, and an underweight position in emerging markets investment-grade bonds. We favor a barbell strategy in terms of duration, with a preference for the 1 to 3 year segment and the 8 to 15 year segment of the yield curve. I'm Jean Chia, and this is Bank of Singapore Research.
For more information, please refer to this month's monthly investment guide.